You have been told a lie about credit cards your entire life. They told you it was about convenience, about not carrying cash, about building credit, about earning rewards. They sold you a story about a businessman who forgot his wallet at a restaurant and invented the credit card out of embarrassment. Except that story is complete garbage. It was marketing propaganda designed to make you comfortable with the idea of spending money you do not have. And it worked. Today, Americans owe nearly $1 trillion to credit card companies. The average household carries almost $8,000 in credit card debt. And the banks that issue these cards are making record profits while their customers drown in interest payments that never seem to make the balance go down. Here is the truth they do not want you to know. Credit cards were not invented to help you. They were invented to trap you. The entire system was designed from the beginning to extract maximum profit from people who could least afford it. And once you understand how we got here, once you see the deliberate choices that built this debt machine, you will never look at the piece of plastic in your wallet the same way again. Let us start with that famous story. Frank McNamara, a businessman in New York City in 1949, goes to dinner at a fancy restaurant. He finishes his meal, reaches for his wallet, and realizes he forgot it at home. Embarrassed, he has to call his wife to bring him money. The humiliation supposedly inspired him to create the Diners Club card, the first general-purpose credit card. The story is so good that it made history. Except it is not true. The whole thing was invented by the marketing department years later to sell credit cards to the public. The real story is way less glamorous. Frank was a regular at this restaurant. He ate there every single day. They already knew him. He already had a tab that he paid monthly. This was not new. Restaurants and stores had been offering store credit for years. You could get a card from a department store or an oil company and charge purchases that you would pay off at the end of the month. The only innovation Frank made was combining multiple store tabs into one card that worked at different restaurants around the city. That is it. No dramatic wallet forgetting. No embarrassing moment. Just a businessman who saw an opportunity to consolidate existing credit systems and charge fees for the service. But notice what happened. They took a boring financial product and wrapped it in a story about embarrassment and convenience. They made it emotional. They made it relatable. Because if they told you the truth, that they were creating a system to profit off your spending and potentially trap you in debt, you might not have been so eager to sign up. Stories sell. Truth does not. Remember that. Now, before we go deeper into how credit cards became the wealth extraction machine they are today, if you are tired of the same recycled financial advice that benefits banks instead of you, hit that subscribe button right now. This is Money Trap Channel, and we are exposing the systems designed to keep you poor while making others rich. We show you how money actually works instead of the fairy tales they tell to sell you products. Subscribe, because what comes next will completely change how you think about every credit card offer that lands in your mailbox. The Diners Club card launched in 1950, and it spread quickly. But here's what is important. It was a charge card, not a credit card. You had to pay your full balance every month. No revolving credit, no carrying balances, no interest charges. It was just a convenient way to consolidate your restaurant bills. And for the businesses that accepted it, Diners Club charged a 7% fee on every transaction. This is crucial to understand. From the very beginning, merchants were paying fees to card companies. This cost gets passed on to all customers through higher prices, even if you pay cash. You are subsidizing credit card, rewards, and convenience fees, whether you use cards or not. For years, this was how credit cards worked. American Express launched in 1958 with a similar model. Charge cards that required full payment each month. But then Bank of America did something different. They launched the Bank AmeriCard, which would eventually become Visa, and they added a feature that changed everything. You did not have to pay your full balance. You could revolve it, carry it month to month, pay interest on what you owed. This was the moment. This was when credit cards transformed from a convenience tool into a profit extraction machine. Think about what this means. Before revolving credit, card companies made money from merchant fees and sometimes annual fees from cardholders. Nice business, but limited. With revolving credit, they could now make money from interest charges. And unlike merchant fees, which are capped by competition, interest rates could be much higher, especially on balances that people carried for months or years. Suddenly, the profit potential was massive. And the customers who made them the most money were not the people who paid their bills in full. They were the people who carried balances. The ones who could not pay it all off. The ones struggling financially. The industry even created a term for people who pay their bills in full every month. They call them deadbeats. Read that again. If you use a credit card responsibly and pay it off completely, avoiding all interest charges, the industry calls you a deadbeat. You are worthless to them. The profitable customers, the ones they want, are called revolvers. People who revolve balances month after month, paying interest forever. The entire business model is designed to identify people who will carry debt and target them aggressively. But wait, it gets worse. In the early days, states had usury laws that capped how much interest banks could charge. New York, where many big banks were headquartered, had a 12% cap, which sounds high until you realize that in the late 1970s, inflation was running at 20% and interest rates were skyrocketing. Banks were paying 20% to borrow money, but could only charge customers 12%. They were losing money on every credit card, so they had a problem. How do you keep making profit when your costs are higher than what you are allowed to charge? Enter South Dakota. In 1980, South Dakota was struggling. Unemployment was high. The economy was bad. The governor, Bill Janklow, decided to eliminate the state's usury laws completely. No cap on interest rates at all. Banks could charge whatever they wanted. And then something magical happened for the banks. A Supreme Court case called Marquette Bank decided that a bank could export its interest rate from its home state to customers in other states. So, if you are chartered in a state with no usury laws, you can charge customers in any state whatever rate you want, regardless of that state's laws. Citibank figured this out immediately. They were hemorrhaging money in New York with the 12% cap. So they moved their entire credit card operation to South Dakota, where there were no limits. Suddenly, they could charge 18%, 20%, 25%, whatever they wanted. And they could do it to customers all across America. Other banks quickly followed. South Dakota and Delaware became the credit card capitals of America, not because of any innovation or service, but because they eliminated consumer protections. Think about what this means. In the 1980s, the entire foundation of consumer lending regulation was dismantled. States had protected their citizens from excessive interest rates for generations. Those protections were rendered meaningless by one Supreme Court case and a few states willing to eliminate their laws to attract bank jobs. And the result? Interest rates on credit cards exploded. Even as overall interest rates in the economy dropped, credit card rates stayed high. Today, in an era of historically low interest rates, credit card companies are charging 25 to 30% to some customers. Rates that used to be illegal, rates that were considered loan sharking. But the banks did not stop there. In 1996, another Supreme Court case called Smiley versus Citibank removed state restrictions on fees, late fees, over-limit fees, balance transfer fees. Suddenly, those were unlimited too. Before Smiley, late fees were typically $5 to $10. After Smiley, they went to $15, then $29, then $39. Today, some are $50 for being 1 day late on a payment. The fee often exceeds the minimum payment you missed. And here's the really insidious part. The banks began manipulating how payments were processed to maximize these fees. Let me explain how this works. You have a credit card with a $1,000 limit. Your balance is $950. You are close to your limit, but not over. You make several small purchases. Coffee for $3, lunch for $12, gas for $40, a grocery purchase for $80. Then, at the end of the day, you make your monthly payment of $200. You would think the bank would process the payment first, bringing your balance down to $750. Then process your purchases, which would bring it up to $888. Still under your limit. No fees. But that is not what they do. They process the transactions in the order that maximizes fees. First, they process the $80 grocery purchase. That puts you over your limit. Over limit fee, $35. Then they process the $40 gas purchase. Another over limit fee. Then lunch. Another fee. Then coffee. Another fee. By the time they process your $200 payment, you have racked up 4 over-limit fees totaling $140. Your payment barely covers the fees. Your balance has not gone down at all. And next month, if you are one day late because you did not realize your minimum payment increased due to all the fees, they hit you with a late fee and raise your interest rate. This is not an accident. This is not a computer glitch. This is the deliberate design of the system. Banks have teams of mathematicians and behavioral psychologists who study exactly how to extract maximum revenue from customers. They know that if they process the largest transaction first, they can drain your account faster and generate more overdraft or over-limit fees. They know that if they set your payment due date on a weekend or holiday, some people will miss it and pay late fees. They know that if they mail your statement late, you have less time to make the payment. Every aspect of the system is optimized to trap you and extract money. And then there is universal default. This is perhaps the most predatory practice in the industry. Let us say you have 3 credit cards. Card A, Card B, and Card C. You always pay Card A and Card B on time. Perfect payment history. But you miss a payment on Card C because of an emergency. Maybe you lost your job. Maybe you had medical bills. Whatever the reason, you were 30 days late on Card C, Card A, and Card B. See this on your credit report. And even though you have never been late with them, even though your relationship with them is perfect, they raise your interest rate from 9% to 29% on your existing balance. Money you already borrowed at 9% is now charged at 29%. Retroactively. Imagine any other contract working this way. You buy a house with a mortgage at 5% interest. 3 years later, your mortgage company finds out you were late on your car payment. So they raise your mortgage rate to 20% on the money you already borrowed. Illegal, right? Not for credit cards. They can do it. And they did it to millions of people. The practice was so widespread and so destructive that it finally got restricted in 2009 with the Credit Card Act. But for decades before that, it was standard practice. Now let us talk about minimum payments. In the early days, credit card companies required you to pay 5% of your balance each month as the minimum. If you owed $1,000, you had to pay at least $50. At that rate, even if you never charged anything else, you would pay off the balance in a reasonable time. But then a consultant named Andrew Carr had an idea. What if we lowered the minimum payment to 2%? If you owed $1,000, you would only have to pay $20. Sounds great for customers, right? More flexibility. Lower required payment. Except here is what really happens. At 2% minimum payments, if you owe $1,000 at 18% interest and only make minimum payments, it takes over 5 years to pay off. And you pay over $800 in interest, nearly double what you borrowed. And most people do not just pay it off. They keep using the card. So the balance never goes down. They are trapped in a cycle of minimum payments that barely cover the interest. Their balance stays the same or grows. And they pay interest forever. This is the business model. Keep people in debt forever. Make the minimum payment low enough that it feels affordable. Make it just barely cover the interest so the principal never decreases. Keep them paying month after month, year after year. This is why credit card companies send you 0% balance transfer offers, not to help you pay off debt, but to get you to consolidate all your debt with them so they can charge you interest on a bigger balance when the promotional period ends, which always happens. The 0% rate is temporary. The debt is permanent. And speaking of 0% offers, those are another trap. They advertise 0% interest for 12 months. Sounds great, but read the fine print. If you miss one payment, even by one day, during those 12 months, the entire promotional rate disappears. Retroactively, they charge you interest on the full balance from day one at the penalty rate, which can be 29%. One missed payment can cost you thousands in interest. And remember how they manipulate payment processing to maximize fees. They are doing the same thing to maximize the chances you miss a promotional deadline. The entire system is built on information asymmetry. The banks have teams of PhDs analyzing your behavior, designing traps, optimizing fees. You have a contract written in legal language that even law professors admit they cannot fully understand. The terms can change at any time with 15 days notice. They can raise your rate for any reason or no reason at all. They track your spending patterns, your payment history, your credit score changes. They know when you are financially vulnerable, and that is when they hit you the hardest. Banks learned that the most profitable customers are the ones closest to financial ruin. Not the wealthy people who pay their bills in full. Not the people with good credit who have options. The most profitable customers are people who are barely hanging on, living paycheck to paycheck, using credit cards to bridge the gap between income and expenses. These people pay the highest interest rates. They pay the most fees. They carry the biggest balances for the longest time. They are desperate and have no alternatives. This is who the system targets. And it worked. By 2007, Americans owed nearly $1 trillion in credit card debt. Then the financial crisis hit. People lost their jobs. They could not make payments. They had refinanced credit card debt into home equity loans. When home values crashed, they lost everything. Millions of bankruptcies, millions of foreclosures. The credit card debt crisis was a huge part of the financial collapse. But the banks got bailed out. The customers got bankruptcies on their credit reports. After the crisis, Congress finally passed some reforms. The Credit Card Act of 2009 banned some of the worst practices. Universal default was restricted. Banks had to give you notice before raising rates. They could not charge you unlimited fees. But notice what did not change. There is still no cap on interest rates. Banks can still charge 25 or 30%. They can still change terms with minimal notice. They still process transactions in ways that maximize fees. The reforms made things slightly better, but the fundamental structure remains the same. The system is still designed to profit from people carrying debt. Today, the average American household with credit card debt owes nearly $8,000. At typical interest rates, if they only make minimum payments, they will pay for decades and pay tens of thousands in interest. The banks make more from interest and fees than from all the stuff customers actually bought. You are not paying for purchases anymore. You are paying rent on old purchases forever. The coffee you bought 3 years ago? Still paying interest on it. The emergency car repair from 5 years ago? Still paying interest. You are working to pay interest to banks on consumption that is long gone. And the system has gotten more sophisticated. Now they offer rewards, cashback, miles, points. They make you feel smart for using cards. But think about how rewards work. The bank charges merchants 3% on every transaction. They give you 1% back. They keep 2%. And that 3% merchant fee? It is built into prices. So, you are paying higher prices for everything, whether you use a credit card or not. The rewards are just giving you back a tiny fraction of the extra amount you are already paying. It is not free money. It is your money being returned to you after the bank takes their cut. The wealthy understand this. They use credit cards for convenience and rewards, but they pay the bills in full every month. They never pay interest. They collect rewards funded by interest payments from people who cannot afford to pay in full. The system transfers wealth from the poor to the rich. The people who can least afford it subsidize rewards programs for people who do not need them. This is by design. This is how it is supposed to work. So what changed in 70 years? We went from a simple charge card for restaurant bills to a $1 trillion debt trap that permeates every aspect of American life. You need a credit card to rent a car, book a hotel, buy things online. But nobody told you that agreeing to convenience meant agreeing to a system designed to keep you in debt forever. Nobody explained that the friendly customer service representative is really a debt collector. Nobody mentioned that your credit score, which supposedly helps you, is really a tool to determine how much debt you can handle before breaking. The history of credit cards is not a story about innovation or convenience. It is a story about the systematic removal of consumer protections. It is about banks lobbying to eliminate usury laws that protected people for generations. It is about Supreme Court decisions that let banks export their home state laws to people in other states. It is about deregulation that allowed fees to skyrocket. It is about mathematical modeling to identify vulnerable people and extract maximum profit from them. It is about creating a permanent debt class that works to pay interest forever. They sold you a story about a forgotten wallet. They gave you convenience and rewards. And in exchange, you gave them permission to trap you in debt. Americans now owe nearly $1 trillion to credit card companies. Money that will take decades to pay back if it ever gets paid back at all. Money that earns interest at rates that used to be illegal. Money that enriches banks while keeping customers broke. This is the real history of credit cards. Not the marketing stories. Not the convenience narratives. The truth about a system designed to extract wealth from working people and transfer it to financial institutions. The question is not whether credit cards are convenient. They are. The question is whether that convenience is worth becoming a permanent debt servant to banks that profit from your struggle. Because that is the deal. That is what you agreed to when you signed up for your first card. And most people never even realized it until they were already trapped. Thanks for sticking with us through this. Make sure you check out the next video that is about to pop up on your screen. We are diving even deeper into the financial systems designed to keep you trapped while pretending to help you. This is Money Trap Channel, and we will see you in the next one.